I ran into an old industry contact the other day, a developer who, just a few years ago, was preaching about how crypto would topple the banking system while wearing a hoodie and flip-flops. But this time, the vibe was jarringly different. He was sitting in a cafe, looking physically uncomfortable in a stiff, brand new suit, staring at a laptop screen that wasn't showing price charts or moon memes. When I congratulated him on Bitcoin rebounding toward $90,000, I expected a high five or a rant about the bull market. Instead, he just sighed and pointed to his screen. It was a mountain of compliance paperwork. He said, "I used to worry about the code breaking. Now I'm terrified that if a shop accepts a token for a cup of coffee and the price jumps 10 minutes later, we'll all get flagged for insider trading." That moment was a perfect snapshot of where we actually are. While the internet hypes up the price, the reality on the ground has quietly shifted from a revolution to a regulatory audit. We are moving away from the exciting Wild West of payments and straight into the dull, bureaucratic world of financial instruments. And honestly, that boring, suit-wearing shift is exactly what we need to talk about today. So our mission in this deep dive is to trace that exact transformation. We're looking at this quiet but utterly significant shift away from the Wild West and into the bureaucratic institutional world of finance. And for that, we have the perfect case study, Japan's recent regulatory overhaul. Specifically, this move to shift crypto assets from the Payment Services Act over to the Financial Instruments and Exchange Act, or FIEA.
And that framework it's just so critical. What's fascinating here is that this isn't just about what's happening in Japan. You have to see this as a kind of global blueprint for legitimizing digital assets.
Yeah.
By treating these volatile cryptocurrencies as, investment products rather than a means of settlement. Japan is essentially providing a roadmap for how these assets migrate. They're moving from being part of a currency discussion, how to pay for that cup of coffee, to being a full-blown financial instrument discussion. And that comes with all the decades of regulation and, all the compliance baggage that entails.
I get the pragmatism of it, I really do, but it still feels like a total surrender of that original revolutionary ethos. We are literally watching the counterculture of finance trade its flip-flops for a brand new stiff suit, and we need to understand exactly what that trade means, both legally and, operationally. Okay, let's unpack this core pivot, because it really is monumental. It's going to define the next decade of finance in Japan and maybe everywhere else. Historically, crypto there was regulated under the Payment Services Act, the PSA.
Right, which was a very light touch.
A very light touch. It was viewed fundamentally as digital money or a way to settle payments. It let the industry just flourish and sometimes crash very rapidly. But now Japan's Financial Services Agency, the FSA, has made this monumental decision to transition oversight entirely to the Financial Instruments and Exchange Act, FIEA. Why was this shift so necessary? And what is the sheer scale of the disruption we're talking about?
Well, the necessity really arose from trauma and growth. I mean, you have to remember Japan's unique history with crypto. They were home to the Mt. Gox collapse, a decade ago now?
A decade ago, yeah. That left a huge scar.
A huge scar. And you combine that with all the recent global turmoil like the FTX implosion, and it basically forced the FSA to act decisively. Their primary stated goal is simple: strengthen investor protection. That's it. And to put the scale in perspective, we're talking about a change that impacts over 13 million domestic crypto accounts.
13 million? That's not a small number.
Not at all. And collectively, they're holding more than 5 trillion yen in deposits. So this is serious institutional money we're talking about now.
And by moving these assets under FIEA, the FSA is explicitly saying crypto is not currency, it's an investment product. It demands the same level of rigorous oversight we see for, traditional stocks and bonds.
Exactly. Stocks, bonds, derivatives. It's an immediate regulatory elevation. Mm-hmm. You can't handle a stock differently from how you handle Bitcoin anymore, at least not from a regulatory perspective.
So how far along is this process?
The legislation itself is progressing pretty steadily. It's expected to reach the regular diet session sometime in 2026. But, and this is the important part, the market isn't waiting for the formal law to pass. The whole industry is already preemptively implementing FIEA standards because, waiting is just too risky. This operational earthquake is happening right now.
Which brings us right back to my developer friend, the one I mentioned. Let's call him Kenji. His situation perfectly illustrates the compliance officer's nightmare this shift has created for what they call virtual asset service providers, or VASPs.
Oh, that's a crucial perspective to bring in. A few years ago, someone like Kenji, a compliance officer at a mid-sized VASP in Tokyo, was focused intensely on security and speed. Figuring out how to onboard users efficiently while battling potential security threats. It was high pressure, very technical work.
Right, code-focused. But today, his reality has completely inverted. He's just buried. Can you describe what his specific, frustrating daily burden looks like now? Because it's not just some abstract idea of paperwork.
No, it's accounting terror. He's battling spreadsheets that demand mandatory segregation of client assets. This means he needs rigorous, real-time proof that customer funds are entirely separate from the company's operational funds, a direct mandate from traditional securities law.
And that's not easy with crypto.
It's a nightmare. On top of that, he has to constantly calculate required capital reserves based on the daily volatility of, maybe 105 separate regulated tokens. He has to ensure the VASP maintains sufficient buffers against market swings, potential regulatory fines, potential hacks. His job has fundamentally changed from battling hackers to just navigating this labyrinth of regulatory accounting.
So the technical difficulty of listing a new token has gone from, can we integrate the smart contract, to can we survive the regulatory screening?
That is the perfect way to put it. The operational cost has just skyrocketed because of that exact change. Listing a new token now requires an intense, almost IPO-like screening process. And this is mandated by self-regulatory bodies like the JVCEA, the Japan Virtual and Crypto Asset Exchange Association. It's not a rubber stamp. It's exhaustive due diligence.
Tell us what that due diligence actually entails, because this is where you can see the speed of innovation just grinding to a complete halt.
Okay, so the JVCEA screening process has multiple stages, and they're all designed to establish a level of trust and transparency that really does mirror an initial public offering. So first, you have rigorous source of funds validation for the initial issue. Second, you need mandatory independent smart contract audit proof to ensure the code is safe and immutable.
Okay, that makes sense.
Third, you need detailed governance structure disclosure. Who controls this asset? Who makes decisions? And fourth, strict lockup periods for the founders and the initial team members to prevent, classic pump and dump schemes.
So you have to prove beyond any doubt that your token isn't just a technically sound product, but a financially responsible instrument. I can absolutely see why industry leaders have been issuing some stark warnings about this.
They're worried the viability of the entire sector is at risk. Your compliance expenses, covering legal counsel, IT infrastructure upgrades, staffing for all this, can easily double or triple the operating budget of smaller exchanges. The warning from one industry representative was severe. He basically said the sector may not survive the proposed measures. The burden is just too high. It favors only the largest, most well-capitalized financial groups.
Which naturally leads to the big question about the trade-off here. We gain safety, for sure, but we risk extinguishing that innovation fire completely. If the FIEA framework is this onerous, is it even worth it?
Well, it's worth it to the Japanese government because they prioritize safety above absolutely everything else. And there's tangible evidence that this framework works. I mean, when FTX collapsed globally, Japanese users were largely protected. The existing stringent regulatory rails, even before this full FIEA shift mandated proper asset segregation and local licensing, they didn't lose their funds the way international users did.
So what here is that FIEA mandates a trade. You surrender agility, you surrender speed, but in return, you get arguably the highest level of investor protection in the world. It's the difference between a decentralized laboratory and a heavily policed urban bank vault. Both are secure, I guess, but only one is fun.
That contrast is absolutely key to understanding the global regulatory arbitrage that's happening. Japan is choosing absolute security over the speed of innovation, period.
So if we look closer at the specific mandates of FIEA, we can really understand why the compliance burden is so high and why my friend Kenji is terrified of simple transactions. This isn't just adding a few rules, it's a complete elevation of the regulatory identity for these crypto exchanges.
That identity shift is the critical piece. Crypto exchange services will now be regulated under standards equivalent to a Type 1 financial instruments business. And that isn't just a label, it's the regulatory DNA of traditional finance.
Okay, for those of us who don't spend our time reading securities law, what does Type 1 financial instruments business actually mandate operationally? What makes that standard so demanding?
It's the highest standard there is. It's applied to securities brokers who deal with proprietary trading, underwriting, derivatives, this serious stuff. And Type 1 status mandates several critical components. First, significantly increased minimum capital reserves. We're talking billions of yen. They're designed to ensure stability even during massive market turmoil.
So no more shoestring startups.
Not a chance. Second, that mandatory segregation of client assets we mentioned, but it has to be verified by regular external audits. Third, specific licensing requirements for all trading staff to make sure they adhere to financial conduct rules. And finally, frequent, stringent regulatory reporting on all trading activity and risk exposure.
That level of scrutiny fundamentally changes the business model from a fast-moving tech company to a highly regulated brokerage. It forces stricter rules for conduct, customer protection, fair trading practices, which is all excellent for the user, but crippling for the startup mentality.
It's a complete overhaul, and it's aimed at mitigating the exact risks that plague the industry. Globally fraud, market manipulation, commingling of funds. We should probably look at the specific investor protection tools they're implementing under FIEA, because they really show how determined the FSA is to fix this problem of information asymmetry.
The first tool, mandatory reserves, seems like a direct response to all the hacks we've seen.
Absolutely. The mandatory contingency reserves ensure that exchanges have to accumulate a buffer. It's there to cover potential losses from unauthorized outflows or internal hacks. So if an exchange is compromised, the customers are not immediately left bankrupt. The exchange itself has a liquid fund set aside specifically for restitution. It moves the risk burden away from the retail investor.
And then there's the enhanced disclosure system, this two-tier framework. This sounds like they're trying to apply Wall Street disclosure rules to the often, let's say, opaque world of token issuance.
The two-tier system is essential for getting regulatory clarity in such a diverse asset class. So on one hand, you have what they call Type 1 tokens. These are tokens tied to fundraising, initial coin offerings, or specific project support where there is a clear, identifiable issuer or team managing the assets. Since that issuer controls the information flow, they're the ones who must provide highly detailed disclosures.
And what specifically does an issuer have to disclose for one of these Type 1 tokens?
Oh, the requirements are exhaustive. They have to detail the token supply limits and any future issuance schedules. They have to provide a complete organizational and governance structure. They have to present verifiable project plans and technical white papers, including milestones. And they have to submit comprehensive technical risk assessments, often including third-party smart contract audits. If you're issuing a token, you have to reveal the full details of your roadmap and security, just like a company going public would.
Okay, and for the big decentralized assets like Bitcoin and Ethereum, what they're calling Type 2 tokens, the scrutiny shifts entirely to the brokerage, to the exchange.
That's right. Since there's no central issuer for a Type 2 token, the responsibility for investor protection falls to the virtual asset service provider handling the trade. The exchanges are required to compile and provide key information to their investors, things like market risk summaries, volatility statistics, details on how the asset is stored and protected, just ensuring transparency even for these widely traded, decentralized assets.
This whole regulatory push also requires expanding enforcement power, right? Especially when you're dealing with bad actors operating overseas, which has always been the industry's biggest loophole.
The FSA is playing hardball now. They plan to intensify actions against unregistered overseas services that specifically target Japanese retail investors. The ones using illicit persuasion tactics and false promises. To do that, the FSA is giving itself substantially enhanced investigative powers. They can issue immediate cease and desist orders and impose significantly harsher penalties on firms operating outside the rules.
And they're even exploring a new regulatory category specifically for decentralized exchanges, or DDX. That seems like a massive challenge. I mean, DXs, by their very definition, don't have a central Japanese legal entity to regulate.
And that exploration really highlights the inherent difficulty of retrofitting old law onto new tech. They recognize that DXs are a growing source of activity and risk, but regulating an automated smart contract is very different from regulating a corporate entity. The goal will likely be to find the points of entry, the interfaces, the wallet providers, maybe the liquidity providers that operate within Japan, and hold them accountable.
This all leads me back to the point that just stops me cold every time. This philosophical and legal paradox of applying securities law to a decentralized asset. The insider trading problem isn't just abstract, it's operational terror. If we treat Bitcoin as a financial product under FIEA, who defines what constitutes insider trading for a token that has no CEO?
That is the nexus of incompatibility. It's the fundamental problem. Japanese securities law, like many others, relies on the concept of material non-public information. Unquote. For a company stock, that's easy to define. A pending merger, missed earnings, something like that. But for Bitcoin, or for some other decentralized token, what constitutes material non-public information? It could just be knowing that a major fund is about to buy a large amount, or even realizing there's a critical vulnerability in the underlying code before it's public knowledge.
And the regulatory precedents here are unforgiving. These restrictions on insider trading and market manipulation, they don't just apply to licensed securities firms, they apply to ordinary people too. The danger isn't just for whales.
Exactly. Let's walk through the specific legal risk that a small merchant faces. This is where it gets crazy. Imagine a merchant accepting a relatively small, volatile, Type 1 token for a product, say, a handmade kimono, priced at 30,000 yen. They convert that token to yen 10 minutes later to lock in their profit. Simple enough. Now imagine they received an email 5 minutes before that transaction from the token's governance forum saying they were about to announce a major listing on a foreign exchange.
That email, that's likely internal. It could be material, non-public information.
Absolutely. So the token spikes 20% right after our merchant sells. This generates an exchange gain of 6,000 yen, which is pure windfall. It's more than the operating profit they made on the kimono itself. Under FIEA's market manipulation clauses, that merchant could risk being flagged. They benefited from information asymmetry, even if they only accepted the payment for purely operational reasons.
The regulatory friction becomes instant and just, overwhelming. The merchant would have to document the source of their knowledge, prove they had no malicious intent, carefully time their conversion, or risk significant legal scrutiny.
The compliance burden forces that merchant to ask, why would I ever accept this volatile asset when a credit card is so simple? The moment you turn a simple payment transaction into a potential investigation for a securities violation, the payment utility of FIEA-regulated crypto instantly becomes prohibitively difficult. It essentially dies. And this functional death of volatile crypto as a payment method, well, it leads us directly to the government's highly pragmatic dual strategy. They've drawn a hard strategic line in the sand. Volatile crypto is regulated as financial instruments destined for the vault of investment. Meanwhile, stablecoins are being promoted for payments, designed for the register of daily transactions.
So the regulatory crackdown on Bitcoin and Ethereum under FIEA serves a dual purpose. It increases safety for investors, and it clears the runway for a bank-led stablecoin future. It essentially removes any competition from speculative assets in the payment space.
Precisely. The reclassification solidifies the legal view that cryptocurrencies are not a viable means of settlement. They are speculative investment products. That legal distinction is the golden ticket for the stablecoin solution.
And stablecoins, which are typically pegged one-to-one to the Japanese yen, are now classified as electronic payment instruments. This is the key, isn't it? They remain squarely under the much less onerous Payment Services Act, the PSA, and are entirely outside FIEA's jurisdiction.
That PSA classification is exactly why they are so functional for commerce. They're treated like electronic cash or a prepaid card. They're stable, yen-pegged, and they don't carry that crippling compliance baggage of market manipulation risk that the Type 1 and Type 2 tokens do. This makes them extremely easy to use for payments and remittances.
There's also this fascinating, quiet battle for control unfolding here, dividing the stablecoin market based on the use case.
Indeed. We're seeing JPYC, which is the native yen-pegged stablecoin, being positioned for retail use. It's aimed at the everyday consumer and small business transactions, essentially digitizing cash for the public. But then the stablecoins developed by the large megabank coalition, backed by groups like Mitsubishi UFJ Financial Group, are anticipated for wholesale corporate transactions and interbank settlement. It's a real separation of powers.
Yeah.
Retail versus institutional finance.
And there's internal pressure to accelerate the retail use of stablecoins like JPYC, too.
Oh, absolutely. Developers and industry advocates are pushing hard for the removal of the current 1 million yen issuance cap on JPYC. Wow. They argue that this cap stifles high-volume transactions and limits its utility for businesses. Removing it would allow JPYC to really accelerate its adoption and compete more effectively against legacy payment systems.
Speaking of legacy systems, we have to talk about the argument that stablecoins are just fundamentally superior to what we use for global money transfers today, specifically SWIFT. The institutional inertia is strong, but the technology is it's embarrassing.
The critique of the legacy remittance system, SWIFT, is really one of functional obsolescence. It's frequently criticized for its long wait times, sometimes days or even weeks for an international transfer, these absurd review processes that halt funds randomly and disproportionately high costs, especially for smaller transfers. In an era of instant global communication, waiting a month for your own money to arise because of some compliance review, it's just an existential disappointment for finance.
I couldn't agree more on the technology. Stablecoins offer near-instant, verifiable, and extremely low-cost global settlement. They're simply a dramatically superior tool. Institutional players might try to cling to Swift because they own the rails, but eventually users will always choose functionality. Swift's disappearance feels inevitable purely based on efficiency.
And if FIEA effectively locks volatile crypto out of the payment arena, their use case has to pivot entirely toward financial engineering. This is where the shift to FIFA actually enables a new class of products, real-world assets or RWAs.
This is where the financialization really pays dividends for the old guard. The path is clear. Crypto assets will be used as quasi-financial instruments for convenient, fractional ownership of actual financial products. Products that were previously too illiquid or expensive for retail users.
The prime example is the emerging development of stock tokens. Consider a company like Progmat, which is closely involved with those megabank stablecoin initiatives. They're developing platforms for tokenizing equities and other financial instruments. This allows for 247 trading in units as small as 1 yen. It effectively democratizes access to assets that previously required buying these expensive lots.
So instead of needing, say, 100,000 yen to buy a minimum lot of a blue chip stock on a restricted exchange, you can buy a tiny fractional piece of that stock, represented by a token, at any hour of the day or night.
Exactly. And this RWA token platform is what the FSA is actually excited about. It justifies the existence of crypto assets not as some revolutionary challenge, but as a technological wrapper that makes traditional finance more efficient, more liquid, and more accessible. It's the highest use case for blockchain technology, a way to modernize the brokerage, not replace the bank.
This is all just beautifully captured by that story of Mr. Tanaka, the shop owner in Akihabara. He was an early crypto believer, wasn't he? Accepting Bitcoin way back in 2017.
He was a true pioneer. But the volatility, combined with the crushing compliance friction created by these impending FIEA mandates, it led him to quietly scrape the Bitcoin accepted here sticker off his register. Accepting Bitcoin stopped feeling like processing a payment. It started feeling like performing a complicated, risky securities trade that required daily documentation.
But his story isn't a funeral for digital assets. He's just watching the stablecoin news now, right? He's realizing the government has effectively segregated the market. Bitcoin is for the vault, stablecoins are for the register.
That's it. He's waiting to put up a new sticker, but this time it will be for a digital currency that truly acts like money, a stable yen-pegged token that's compliant under the PSA. It's less romantic than the original cypherpunk vision of independence, sure, but it's the pragmatic reality that's necessary for mass adoption.
Okay, so once we accept the premise that volatile crypto assets now fall under FIEA, the next logical conclusion has to be the consolidation of the entire virtual asset service provider industry. If crypto is a financial instrument, who is best equipped to handle it?
Securities firms. Without question. They are the entities that have spent decades mastering FIEA compliance, risk management, and client asset segregation. They already have the licenses, they have the compliance staff, they have the regulatory frameworks in place.
So the prediction then is that crypto exchanges won't survive as these independent entrepreneurial tech firms. They'll just be absorbed across the board. They'll become the in-house blockchain technology divisions for these larger financial groups.
We are already seeing this absorption happening in real time. Aside from a few heavily capitalized independent players, most of the major exchanges in Japan have already been integrated into larger corporate groups whose parent companies already operate securities businesses. This consolidation isn't just strategic, it's a regulatory necessity. Only massive financial entities can actually afford the Type 1 financial instruments business compliance burden.
And this necessity is reinforced by the abysmal track record of early decentralized fundraising methods, right? Specifically, initial exchange offerings, or IEOs. These were attempts by exchanges to mimic IPOs, but with just disastrous results.
The data on IEOs is brutal. Analysis showed that upwards of 95% of tokens launched through these offerings crashed below their initial listing price. They often led to near total losses for retail investors. One industry commentator described the IEO sector as looking like a self-destructive trading scheme.
And that failure just strengthened the regulators' resolve. If retail investors are going to participate in structured fundraising via tokens, you need experienced financial operators in charge of the issuance process, not just tech pioneers.
Securities firms have to handle such offerings because they have the experience to manage supply and demand, to manage post-listing stabilization mechanisms. They know how to prevent the spectacular failures we saw during the IEO boom. The failures of the Wild West directly enabled this bureaucratic takeover by FIEA.
All right, let's pivot to the payment side of the ledger. We've established stablecoins are efficient and compliant. So logically, given the rise of these ultra-efficient stablecoins, the traditional credit card system should just disappear entirely. But it won't. Why will credit cards stubbornly survive this technological revolution?
There are two compelling, deeply entrenched reasons, and neither of them has to do with superior technology. The first is the massive ecosystem and the tightly knit power block of credit card companies, banks, and merchant acquirers. This power is structural, not technical.
We have to unpack the Rakuten card system here because it illustrates a near-perfect corporate funding scheme that technology simply cannot kill.
It is an absolute masterclass in financial engineering and sticky customer loyalty. So users are given these high point reward rates, which incentivizes massive usage. Merchants feel compelled to accept the card to capture that huge, loyal user base, and internal fees disappear when users use other related Rakuten services. But the genius part is the float.
The float being the time gap between when the consumer pays and when the merchant actually receives the funds, which can be, 45 days?
Exactly. The more Rakuten card payments that flow through the system, the larger the pool of funds that accumulates within the Rakuten group. This structure allows the corporation to effectively borrow that massive pool of money, interest-free, for its own corporate financing needs, all while skimming a 2-3% merchant fee right off the top.
It's an optimized funding scheme that creates a powerful dependency. Merchants might hate waiting 45 days for their money, but they cannot afford to lose the sheer volume of sales that come with the Rakuten user base.
And this structural power is reinforced globally by giants like Visa and MasterCard. And we have to remember who controls the flow of money. The banks. Banks could, if they chose to, simply insert clauses into commercial loan agreements prohibiting their recipients from accepting any payment method other than their affiliated credit card. That is raw, untouchable market power.
That structural inertia makes the credit card system almost unkillable. What's the second reason for their survival, the more psychological one?
They sell status and community. Credit card companies are experts at selling brand value and a tool for community building. Just look at the most exclusive cards, like the American Express Centurion card. As long as a significant segment of wealthy consumers believes that flashing that specific card carries prestige or grants access to a specific club or an exclusive lounge, that loyalty will persist.
So prestige is completely decoupled from rational financial benefit. People pay for the feeling of status, which is something a functional yen-pegged stablecoin just cannot replicate.
It's emotional and sociological. Credit cards are selling an identity. Stablecoins are selling efficiency. In the retail world, identity often wins.
So if credit cards stubbornly survive, most other proprietary digital payment methods, the ones that are neither credit cards nor stablecoins, they're on the chopping block. They'll be gone within 5 years.
Most proprietary digital payment systems, even popular and well-loved local services like FIEA for transit, face an existential threat. And it's due to excessively high system maintenance costs. Think about what it takes to run these systems. Issuing physical cards, maintaining readers, running 24365 on-premise servers just to check a balance. This technology is archaic and vastly expensive to maintain.
And the system costs of these proprietary services are ultimately borne by the users, hidden in fees or tax subsidies. When users realize the massive cost disparity, these proprietary services versus the dramatically cheaper, safer, and faster public platform provided by blockchain and stablecoins, they will stop shouldering that cost.
Therefore, after all the technological evolution and regulatory shifts we've discussed, the entire landscape of payment providers will consolidate into a surviving trio. You'll have stablecoins for efficient transactions, credit card companies for volume and loyalty, and banks who will control the underlying flow of money and loans. That's it.
If Japan's approach is the very definition of safety first, forcing crypto into this rigid, hand-me-down mold of FIEA, we have to look at the global competition. The EU's Markets in Crypto Assets Regulation, or MiCA, offers a genuinely sharp contrast. This comparison really illustrates the global race for where the next generation of builders will choose to operate.
Japan is structurally safe, no doubt, but its decision to mandate a regulatory retrofit forcing new technology into the requirements of, 1990s securities law, it risks driving innovation away. We can see this frustration clearly in the plight of someone like Hiro, the Web3 entrepreneur in Tokyo.
Right. Hiro had built a decentralized finance protocol focused on lending and staking in Japan. But his token was being squeezed into the FIEA box. It was demanding disclosures and organizational rigidity that fundamentally contradicted his decentralized governance model. He was looking enviously at Paris, wasn't he?
His dilemma perfectly sums up regulatory arbitrage. In Japan, he faces a hostile integration. The regulators are essentially saying, we don't care that you're decentralized, you must appoint a responsible party and comply with Type 1 mandates. Meanwhile, the EU, through MiCA, has created a clean regulatory slate.
MiCA is the true pioneer here. It offers a single, comprehensive licensing regime across the entire EU for crypto asset service providers, or CASPs. That is an enormous strategic advantage.
It creates instant scalability. This unified licensing includes passporting, which means a single license issued in any EU member state, say Paris, is valid across all 27 member states. So think of a mid-sized CASP wanting to serve customers in Berlin, Rome, and Madrid. Under a non-unified system, they'd have to apply for licenses in potentially 26 separate jurisdictions. Under MiCA, they get one key and they can access the entire market. This dramatically reduces legal complexity and cost. It encourages builders to come.
You contrast that with the United States, where the classification relies so heavily on the ambiguous, decades-old Howey test. It leads to years of expensive litigation just to determine if a token is a security, creating this climate of fear and uncertainty.
MiCA bypasses that entire problem through clear, explicit categorization. It defines three primary token types: e-money tokens, which are stablecoins; asset reference tokens, backed by a basket of currencies or assets; and utility tokens, which grant access to goods or services. Each category has specific, transparent rules regarding issuance, reserves, and redemption. This structure eliminates the ambiguity that paralyzes innovation in these reactive, enforcement-led jurisdictions.
And when it comes to investor protection, MiCA takes a much more proactive approach, which is far stronger than the often reactive, punishment-based models we see elsewhere.
Right. MiCA mandates detailed white papers, risk disclosures, fee schedules, and conduct rules before an investment even takes place. This preventative measure offers stronger, more consistent consumer safeguards rather than waiting for something to fail and then punishing the bad actor. Furthermore, MiCA ensures that CASPs align seamlessly with comprehensive EU anti-money laundering directives, including enforcement of the travel rule and maintaining centralized registers for high-volume transactions.
So MiCA is strategically carving out a leadership role for the EU, positioning itself as the most stable and comprehensive environment for institutional-grade crypto businesses.
It is absolutely setting an institutional benchmark for global regulatory harmonization. While the U.S. influences the global discourse through high-profile enforcement actions, which are really just expensive years-long court cases, it lacks a comprehensive law. That limits its effectiveness as a viable template. Asia is mixed. You have innovators like Japan demanding safety and Singapore creating specialized licensing, but there's no cohesive regional model. Hero's ultimate choice, looking at the safe, isolated structure of Japan versus the clear, unified, and expansive framework of Europe, perfectly illustrates why MiCA is winning the global race for builders.
We've spent the better part of this deep dive establishing this inevitable future. Safe, bureaucratic, financialized, and dominated by stablecoins for payments and securities firms for fractionalized real-world assets. The regulatory victory is complete. But I can't shake the core reaction from so many of the crypto pioneers, which is just this profound existential disappointment. They look at this future and they say, wow, this is insanely boring. This is a neutered vision.
That disappointment is the critical starting point for the philosophical counterargument. Treating crypto purely as a quasi-financial instrument strips away its revolutionary potential because it accepts the limits of traditional monetary definitions. It forces us to ask, if we can't beat the banks at the payment game, then what was the true purpose of this technology in the first place?
And the philosophical escape suggests the only way to truly unlock crypto's power is to abandon its monetary and payment functions entirely, to seek a definition of value that capitalism has never been able to measure.
Well, we have to start by redefining money itself. Money is fundamentally a shared illusion. It's a social technology that only functions because of our collective belief and trust in the system. But the most profound, value-creating human interactions, love, forgiveness, reciprocity, genuine community building, they exist perfectly well without any monetary mediation. They are inherently valuable, but they're outside the ledger.
We're so indoctrinated into believing that monetary exchange is the entirety of human interaction, yet the biggest value exchanges occur completely outside the bank statement.
The breakthrough is realizing that the true purpose of cryptocurrency isn't to be money, but to be a measure of that non-monetary value. It should be a credit rating of the shared illusion, a quantified measure of how many people find value, trust, and shared philosophy within a community. We can call this communication value.
That's a fascinating concept. If we look at the core of human exchange, we see this value at work, even if we can't quantify it. I'm thinking of that classic story of the young boy who couldn't afford medicine and tried to steal it, only for the gentle street vendor to forgive him and give him the medicine for free.
Right. That initial act of kindness might have been worth only a few hundred yen of medicine. Years later, that boy, now a successful doctor, saves the vendor's life and waives the massive medical bill, potentially worth 1 million yen. What was exchanged there over the span of a decade was not monetary value. It was a sustained, recorded act of communication and reciprocity.
So communication itself is the underlying currency. Blockchain, then, isn't a ledger for tracking transactions. It's the technology that preserves these communication histories. It's a permanent record of human connection and action, making the trust inherent in that relationship quantifiable.
And this reverses the traditional financial sequence. In the current system, value is determined first like a stock price, and then actions follow. In this new philosophical framework, you start with the action and the record.
So first, you record the action or the communication on the blockchain. Then, the community holding the tokens can vote on that recorded action to democratically determine its ethics or its value. It's a collective democratization of the shared illusion.
Exactly. The exchange value, the price, is determined as a result of the record of human interaction, not as the starting point. This is the only way to truly capture the intentions and the moral weight behind human communication that traditional bureaucratic finance is entirely incapable of measuring.
This philosophical framework needs a practical application, though. If we accept this premise, how do we foster a new, healthy crypto market that's focused on this communication value instead of just pure financial speculation?
The proposal is the creation of a lightweight regulatory sandbox market. It would be specifically designed to screen out the low-effort projects that just want to raise money and run the way IEOs did. The critical intervention here is the liquidity pool cap.
How does that work?
You impose a small cap on the initial liquidity pool, say 5 million to 10 million yen, a very small LP cap. This acts as an explicit barrier to entry for whales and a deterrent for bad actors. If you can only raise, say, $70,000, it's just not worth the effort of creating a sophisticated pump-and-dump scheme. It forces founders to prioritize community building over quick capital raises.
And the screening process for entering the sandbox would focus entirely on qualitative metrics.
Exclusively. The screening would assess the communication value. You could use analytical tools to visualize the philosophy, the community engagement, the quality of interaction, the historical record of the communication within it. You wouldn't be looking at technical solvency or market cap. If you don't have a vibrant, engaged community, you don't get in.
And finally, the transition from the sandbox to the main market. How do you prevent the initial team from dumping their tokens the second they get access to a larger pool of funds?
The mechanism is a tightly controlled lockup. After a successful monitoring window, maybe 6 months of proving communication value, the token can transition. Crucially, a designated portion of the team's holdings, even up to 500 million yen's worth, is locked up for years. This multi-sig control would be assigned to an independent association review committee.
So the core team cannot cash out until the association committee agrees they have fulfilled their long-term commitment to the community. That really incentivizes commitment and trust.
It guarantees that the team's longevity and reputation are intrinsically tied to the success of the communication value. This model creates an ecosystem where the true intrinsic value of the cryptocurrency community, trust, communication, is quantified and protected. It offers a genuine alternative to the purely financialized path that Japan and other jurisdictions are currently pursuing.
This is the ultimate long-term challenge to that boring bureaucratic future we saw laid out in the FIEA mandates. What we've seen in this deep dive is a defining moment for digital assets. The global financial system is demanding maturity and safety, trading the hoodie for the corporate suit, and Japan's FIEA framework is the epitome of that requirement. It successfully protects millions of investors and brings crucial structure, but in doing so, it forces innovation into a rigid, old-world box.
We are left with two clear diverging paths that define the immediate future. The first path is bureaucratic, it's safe, and it's inevitable. Stablecoins, operating under the Payment Services Act, will dominate payments and remittances, successfully displacing legacy systems like SWIFT. Simultaneously, security firms, empowered by FIEA, will absorb exchanges and dominate financial products using crypto technology purely to enable fractionalized ownership of real-world assets.
But the second path, The revolutionary promise of blockchain lies outside of those monetary definitions entirely. It rests in the philosophical escape in measuring human connection, shared philosophy, and communication value. That dimension of value, which traditional finance cannot yet touch, is where the next major breakthrough will have to occur if blockchain technology is ever to fulfill its promise beyond simply making banking slightly more efficient.